All right, so to start off here, what I usually like to ask is how many new traders are in the room, how many more experienced traders are in the room, just so I have a sense of taking the class, or not the class, but here this webinar this morning, a little bit more advanced, maybe in a way, or more the basics, right? I don't want to go into too many technicals without experience. Okay, good. Beginner, Gary, thanks. So we have a good mix. All right, so to begin here, I have a lot of videos on YouTube. I have a lot of videos on the Day Trade to Win homepage. And usually when I do these webinars, I like to show you a mix, things that you should look for, what trading means to me, right? And so I'm actually interested in kind of going over, how to approach this day in and day out. And so what I like to do every morning is, and this is what I tell all my students as well, I say, we have to prepare every morning in the same way, even though every day is different. Every day the market can go up, it can go down. So let me do this here. The market could go up, it could go down, right? But if we have something that could help us understand why it's going up and why it's going down, and maybe formulate a plan around it before the market opens, I think that we are in a better position to take a trade, to filter a trade. And this could be actually in any market, in any really any time frame if you think about it, because price action should be just focused on just the candles and the price. So every morning the first thing I do is I look at the news events. Now there's here on the left-hand side a little indicator here that I actually offer for free. It's called the news indicator. And let me show you first how to start this off. For those of you who don't have the news indicator is available under the free software of DayTradeToWin.com. And here, what I like to focus on here are the settings for it. The low priority, well, I'm not really interested in the low priority news events. I'm more interested in the high priority news events, so I set that to false. I look at today's news events, not only today, but tomorrow and into the future, and that's why you see here a few of them for today and tomorrow. Set that to false. And I need to see the US news events because they primarily move the market. And after I make these changes, you can change colors and things like that, and you can have a sound file. I right click anywhere here in this box and I set it as default. So really the first thing I want to do is know if there's any news, and I use here my news indicator. You can also look at the Bloomberg economic calendar. You can look at the Forex Factory has an economic calendar. You can really look at any calendar. So the idea here is to understand if there's news, I should stay out of the market until the news has been released. When I look at, excuse me, the market moving up and down and up and down, when the news events occur, which are typically at 8:30 Eastern Standard, 10 o'clock Eastern Standard, and sometimes you have the Janet Yellen speaking, which is not always listed as a red star, red flag, or red text. Those are situations that could really make an impact on what we're doing. So news is very important. I recommend don't even approach the news, stay out of the news when it occurs, because there's a few things that could happen, as most of you know here. The news event, if it comes out at 10 o'clock, the timestamp, just so you know how NinjaTrader works, not every charting platform is the same. It's based off of the closing candle. So this candle, which is listed as 10:05, is when the news is released, and you should see a very large candle. So stay out of the market, wait until it passes, wait until the market has cleared out of the way, and then you can jump in and say there's no news or the market's back to normal. So what do we consider as a situation where we should stay out of the market? Well, the first thing I do is, if there is news, is I don't trade, and then after, let's say, 2 candles, 3 candles, everything gets back to normal. So you may see a candle that looks really large, high to low, and then it gets back to normal. So this is a reaction to the news. And then the market continues on its way normally. Now you have to ask yourself, why does this candle occur? Why is it so large? Well, it usually is larger than normal because everyone just jumps in at market. They buy, they sell, but it's usually a market order. And here on the dome, let me bring up my dome here in just a moment. You have a situation where it's trying to put the buyers to the sellers. And under normal circumstances, it could do a very good job. But when there's so many buyers and sellers, as a zero-sum game, there has to be one buyer for every seller, one seller for every buyer. The market begins to jump around looking for these prices. So if you think about a supply and demand feature, you have all these traders looking to buy, all these traders looking to sell because of the news event, and then all of a sudden the market goes crazy looking for the opposite side. For every buyer, there has to be a seller, so the market starts to really go crazy. Now, it's always kind of a short-lived thing. Sometimes it lasts a little bit longer if it's some significant news, but it's usually short-lived. And so just wait until it has surpassed, and then you can go ahead and continue trading. Now, the next thing I do is I look at what happened yesterday or what has been happening in the market overall. And here, let me show you something here for a minute. If I look at the daily chart here, you're going to see that there are instances where the market is very large, where the candles high to low, and you have an instance where the market is very tight range and choppy. But you're going to notice that these days typically happen in groups or clumpings. So even though every day is independent of each other, look at a situation of a cycle of 3 to 4 days where the days are tight range like this, or like this, or like this, right? And then you have, on the opposite side, you have days that are larger, which are typically back-to-back as well as groupings. And you'll see it like this here. Like that, or like that. Here is July 4th, and then Friday. So you have a holiday mixed with a regular day. But typically you have days that are the same, I would say. And here's just a couple of days ago here. Not July 4th, sorry. It was June, May. But you have a couple of days that are in a grouping or clumping that are pretty much the same, high to low. Now, the reason why I'm suggesting that you look at this is because if yesterday was a day that acted a certain way, or was a trend, or maybe didn't do anything, was a non-starter, where it was very tight and a lot of chop around, then you can pretty much assume that today will be more of the same. 4, 5, 6 days in a row are typically normal cycles for a market. And I would say this is the same for any market. It's not really anything just for the E-mini S&P. Now, this day is a lower close and open. This day is a higher close and open, a green bar, another green bar. But you're going to notice that the range, I would say from here to here, 15 points, is exactly the same, or not exactly, but I would say very close to the following day, the following day, and the following day. What I can expect moving forward for today is that we're not going to have too much of a difference when you compare it to this day, or this day, or this day. Now, the tool that I really like to use, and I have a lot of videos on this, which I recommend everyone look at, and I'm going to go over today as well, is this ATR, the average true range. The ATR is one of the most undervalued indicators or tools that traders overlook. So the ATR is right here, is the average true range. And this ATR is based off of a certain number of candles, whatever number you give it. I usually give it a number of 4. And this ATR tells me that the last 4 candles, on average, were able to move high to low a certain number of points or ticks or pips. And If I understand what the market can do or has just done, then my expectation is that the market's going to go into the future pretty much the same. Now, you're not going to see big moves on the ATR. It's going to be a gradual day-to-day change, unless there's a news event or unless there's really something that creates a larger than normal candle or day. So when I look at the type of day that we have, I can say we're looking at about a 13-point day based off what the market has just done. Now, it could be today a 14-point day, it could be a 12-point day, but it's not really going to be a 25-point day or a 50-point day. It's going to be more or less what you see here. Now, as you approach the day in the morning, if yesterday was a trending day, then you can expect another trending day today, but don't take into account the direction. You can say it could be a trending day up or it can be a trending day down. And so you can see here how even though each one of these candles has a similar high to low 25 points, right? This could be the same 25 points here, right? One is a trend down, one is a trend up, or a large sell-off, a large buy. But they are similar as far as the range that they created. When you go into the day, you have to have expectations. So I expect if there's a day like this, that tomorrow is going to be similar, 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 and you can see that it's gradually changing, not that much. I have to trade this type of day different than I trade, for example, I would say maybe these days here, where it's much slower, and the ATR that you're seeing here in comparison, 25, 23 is now 12. It's a different type of day completely. It's a day that may be choppy. It's a day that may be in a tight range. So I think it's important to understand first what happened yesterday, or what grouping of days are we in order to really have an expectation of how to approach what we're doing. So when I look at here the day going forward in time, if the similarity between looking at this and this and this, I have really only to say that today could be a similar day than what you're seeing right now. So when as I approach the day, if yesterday was a trending day, I could expect a trend. When you listen to the person on the TV, they say the market rallied big today because of Apple or because of a stock. The next day, the same guy on the TV or on the radio says the market really gave it all back and all the gains have been wiped away. Usually they say it's because of profit taking. And I like to say it's not because of profit taking. It's because one day is a trend up, one day is a trend down. It could be because of any reason, news, but focus on the type of day more importantly than the direction, because the direction doesn't really matter. The money and the profits and the losses occur regardless if the market go up or down. So as I look at a 5-minute chart here and starting off the day, I look at what has happened, what kind of day we're in, and then what I want to do is say, well, if yesterday was about 25 days, 25 points, I should say, then I could expect more of the same. Now, on a 5-minute chart as a day trader, this gives a huge advantage, because if there's a move that happens on a 60-minute chart, the 30-minute chart, the 15-minute chart, the 10, the 5, I'm able to catch it on this 5-minute chart. So news events usually occur on the hour, on the half hour, which the 5-minute chart is able to keep you out and also catch them. Now, most traders in the world are looking at one of these time frames. I don't know really anyone who's trading, let's say, an 8-minute chart or a 4-minute chart. They're trading either 5, a 10, a 15, a 30, a 60. So the 5-minute chart is ideal to catch it. It's divisible by 5, and that's what I recommend. Now, when the market's slow, you shouldn't trade when the market's slow. You should trade when the market is normal. So whatever market you're looking at, doesn't matter what it is, know when it's not the right time to trade. So on the E-mini S&P, here is a 1.4 tick minimum that I want to see in order to trade. When the market's more volatile than normal, I would say you're looking at 4.75 of a point. So whenever you have these extremes, which are 1 point or 4 ticks, and 5 points, which is 20 ticks, 1 point, 5 points, these are instances where you need to stay out of the trade. So know if it's even worth trading, what kind of conditions you're in. So the first thing I do every morning is I look at news. I look at whether or not the market's tradable. Is it too slow? Is it too volatile as well? And back to this ATR, if I know that on this 5-minute chart, 7 ticks is what I can see the market has just traded, then I could say into the future, whether I go long or short, I could expect very similar 7, 8 ticks up or down. Now, what that means to me is that my stops, my targets, the way I manage the trade is already known in advance. You have to know a lot of what is happening before you take a trade. So if it's too slow, you already know it. If it's too fast, you already know it. What's the target? The target should be relative to the current conditions, not just because you want to take a point or you want to take 20 points or 3 or whatever it happens to be what you want it to be. It's what the market can provide. So I always round down. I'm always more conservative. If the average true range is 1.88, I round down to the nearest quarter point tick here on the E-mini, which would be 7 ticks. Also, if you realize that there's news coming right around the corner, it's time to get out of the trade and wait it out. It may or may not impact what you're doing, but it's time to stay out of the trade. I am going to show you a few of my Atlas line and a few of my trade scalper, things like that in just a minute. I just want to set you up here with preparation, because we just can't jump in to the market hoping it's going to happen or thinking it's going to happen. We have to really focus on what can the market give me and what can the market do. Now, once you're in a trade, the other, I think, mistake a lot of traders make is that they hold on to losing trades for too long, or they hold on to a trade for too long. Limit the amount of time that you're in a trade. So if you're in an Atlas line trade, or you're in a pair of price action trade or a scalping trade, it doesn't matter. You want to see an immediate move into your goal. If you hold on to a trade and you're holding on to it and you're holding on to it and it's not going anywhere, the longer you hold on to a trade that's not really going in your favor, really the worse you are. Now, I like to hold on to trades. This is money management. This is trade management. You enter, I know exactly what the profit is going to be. It's usually 1 times the ATR, always rounding down. Even if you want to be a little bit more conservative by a tick, that's great. So I know the target. I know my expectation. I also know that I can't really hold on to this for an hour or two. I need to see an immediate move into my direction within the next 4 candles. Now I'm looking at a 5-minute chart, so that would be the equivalent of 20 minutes. But if you branch it out and you think about a 60-minute chart or a 30-minute chart, it's equivalent. It's all relative. On a 60-minute chart, the ATR is larger, and you hold on to it for 4 candles or 4 hours. Here it would be 20 minutes as a day trader instead of so much of a swing trader. So you limit the amount of time you're in a trade. You know the expectation. Let's talk a little bit about stops as well. When you look at a stop, most, if not everyone, wants to lose the minimum amount of money possible with the smallest amount of risk. So risk here is very important. Risk is defined by a lot of different people in different ways. And by the way, if anyone wants to chime in here and um, really let everyone know what their risk tolerance is or what their understanding of risk is, I'm more than happy to pass it along. But risk is important because when you think about risk, you think about the amount of money that you could lose. But you have to realize that risk is relative as well. If the current conditions tell me that 7 ticks, you see it hasn't really changed that much here on this next candle. It's still the same, 7 ticks. If it changes anything, it may change by a tick or two up or down. But when this risk here is understood, you don't have to risk more than it's worth. You also have to risk enough to keep you in the trade. So this average true range that I'm showing you, the ATR, helps me understand that if I go short or if I go long, my stop initially has to be larger than the current conditions. Because if this candle made 7 ticks, the next candle could easily move up or down 7 ticks. And if my stop is 3 ticks or 4 ticks, because I'm concerned about risk or I'm concerned about the losing money, just the random movement of the market moving up and down and up and down, 7 ticks, right, could stop me out prematurely, and it's unnecessary. So if I see that the current conditions are one value, I know that my stop initially has to be larger in order for me to stay in the trade. So even though my risk tolerance is only 4 ticks, I know that being just 4 ticks is not going to help me if the market can move up or down 8 ticks. And so it will easily stop me out just on random movement. So again, it's relative. We have to look at not what I want or not what I expect. For it to happen, I have to look at what the market is showing me that it could do. And that's why when I say the market is overly volatile at 20 ticks or 5 points, it's not worth me risking more than 20 ticks on any trade. So anything that I teach has a maximum loss of 20 ticks. Usually I double the ATR up to 5 points. That's the catastrophic stop, as I call it, because if I'm going to stay in this trade and even give this trade a chance, I have to give this more than what the current conditions are showing me. And then I want to formulate a plan with a specific target. If it's too volatile, it's always a maximum of 5 points. So if the ATR is at 4, I'm not going to risk 8. It's just 5. When the market reaches 5 points, I do nothing. I stay out. It's too volatile. Okay, so in my opinion, if your stop is equal or less than the current conditions, you have a greater possibility of getting knocked out of this trade without giving it even a chance to work. So it has to be a little bit larger, maximum of always 5 points. So risk can be looked at in first that way. Is it worth my risk of 5 points? Can I tolerate that? And if not, then look for them when the market's slower or more under normal conditions. Now the other aspect of risk that a lot of traders don't think about is this overbought, oversold criteria. So let's say that the market's kind of moving around here and you decide to go long or short. When the market, let's say it breaks out, type of a breakout kind of move, you have a situation where you're entering long here, way up here. So here comes the details. How do I know when I enter long here that the market has enough push and momentum to continue the move up for me to be successful on this trade? Maybe this is the end of the move. Maybe the market's overbought already. Maybe there's no other buyers and you're the last buyer and now everyone's going to take profit and take it down to sell it. So overbought, oversold, overexhausted is something that you may have heard about, but you definitely have to consider whether or not it's worth taking the trade. Because if the market has already made the move, already made that move for that area of time, it's not worth the risk. Okay? So let me show you here on the Atlas line a great example of overbought and oversold and how you should filter out trades if you're thinking about going long or going short. Remember, after the market's made a big move, it doesn't necessarily mean it's going to continue. As a matter of fact, I can probably say with greater certainty that after the market makes a large move, like you see here, this large move here, that at some point, maybe not on this candle or this candle, but it's not going to last. And when you see large candles, it doesn't always follow through. There's almost a holding or a reversal or a pause or catching its breath type of situation. So let me show you here on the Atlas line what I mean by that. And here is the Atlas line. You can have a sound file. You can have a filter. Remember, the filter is when the market's too slow, let's not see a trade. So here is the using the ATR with a value of 1 point or less. I won't see a trade. You can set that on or off. I live in Eastern Standard Time, so I have to set it for when this market opens for me. And I have bounce trades. I have double bar long, double bar short. I have pullback and strength trades. And so when I add here the Atlas line here for the E-mini S&P, you're going to see that today there's a long signal way up here. So going along here really didn't produce anything because as the market gave you this long 1, 2, 3, 4, 5, market pulled back. It actually retraced a little bit. So how do I know before taking this move or any move that it's overbought or oversold or really not worth taking the trade? Well, what I teach when you do attend the training for the Atlas line, or for those of you who have the Atlas line here in the room, is that even though the signal is telling you to go long, let's make sure first that it isn't overbought or oversold, or there's nothing here that will stop me from taking the trade. So what I do is I have a reference point. The reference point being the Atlas line itself, which is here. This has a value of 2093.75. And I try to use as exact values as possible. So remember to use the crosshairs. For those of you who just use the pointer, use the crosshair so we can have an exact value. So the Atlas line here, when this signal was produced, is about 2093.75, right? Now the entry being 2101 is pretty far away. So remember, if I go long here, the market still has to move higher in order for us to be successful. I'm not going to take a trade unless I think that there's a chance of success. So how do I know the market, even though this is giving me a long entry, how do I know that it's going to go higher and I can be successful in continuing this move up? Well, we have to look at overbought and oversold. If there's not news that is stopping me, if the market's not too slow, if the market's not too fast, what I like to do is compare this entry, which is 2150, you can see right there, with where the Atlas line is plotting. And this value leads me to overbought or sold. So there's a reference point here made that I can't just take any trade or any signal. What are the possibilities that this is going to continue? And the possibility is that based off the current conditions, again, it's all relative. If the market's more volatile, if you're looking at a different market, if you're looking at a 15-minute chart, it's all relative. I know that the next candle can move about 7 ticks. So that means that if I'm going to have a chance of success, 7 ticks is what I'm after. But can this market make 7 ticks, right? Big question. So I compare the distance between where the Atlas line is plotting and where the signal is being generated, and there's a value. There's 7 3/4 of a point. So I'm already 7 3/4 of a point entering long after you see the Atlas line and the entry long. How do I know it's overbought or oversold? Maximum distance is always less than 2 times the ATR or max of 5 points. Now remember, my maximum stop is 5 points, so I'm already entering more than 5 points away. If I enter long, I want to have a protection that protects me with time, with proof, and so the only real cause here is this distance to travel back down to the Atlas line. If this market's going to go up, it has to give me a signal closer rather than further away. If this distance is more than 3.5 points or 3 3/4 of a point, doubling this ATR, it's not worth taking the trade. It's overbought, and it would be the same if there were two very strong red candles at any time throughout the day crossing the Atlas line. I can then say, what are the current conditions? Is it worth me taking the trade? Because it's definitely either not more than 2 times the distance away from the Atlas line when the signal is generated, or it is. So the closer you enter, you're entering first at the beginning of a move up or down with a higher chance of success for it to continue and reach your goal. But you don't want to be the last guy long or the last guy short, and then the market takes a break, it pauses, it is pulling back. So we have to know if the market is overbought and oversold at the time of entering. The Atlas line, when it generates the signals, tells me right away, am I entering after the fact, after this move has already happened?